I'm Nicolas Papageorgiou. I'll be moderating the session. I share my time between HEC Montreal, which is the French Business School in Montreal, and BROCKHOUSE, which is part of Pavilion Asset Management, Pavilion Financial Corporation, I should say. I work as director of quant research there. Basically, we implement. We design and implement solutions for clients, mostly overlay strategies through managed accounts, risk management, and kind of liquid alternative strategies that we propose to clients on managed account basis. That's the part of the work I'm involved with. We have a very interesting panel, I think, today. We're going to be talking a little bit about the hedge fund industry, where we are today, on the Canadian and global basis, and looking at both the kind of institutional and retail perspective. And we've got a great panel. So we have Pierre Laroche from Banque Nationale. We have Ray Carroll from BRETON Hill, and Gary Ostoich, who's president of AIMA, and
President of SPARTAN.
And President of SPARTAN. He's actually pinch hitting for us. So on the official agenda, there's Robert Klein's name. You know you have a deep bench when you could bring Gary in to pinch hit. So it's great to have him on the panel today. I'll let the panelists introduce themselves, and then we'll kind of go through the themes.
Okay, thanks, Nicolas. Thanks for being here. So I'm Pierre Laroche, heading derivatives product R&D at National Bank Financial. Before doing this, I spent about 5 years at INOCAP, which was National Bank of Canada and BNP Paribas managed account for hedge funds platform. And before that, well, you know, I was on the light side. Before joining the dark side, I spent 15 years in the academic sector or academic business. I don't know what to say now. So at HEC as well, this is where I met Nicolas.
Actually, just to add that, Pierre gave me my first job out of grad school. So if I favor him, if I'm a little bit biased towards him on the panel, you know why.
All right, well, great to see a full room at 4:30. So I'm Ray Carroll, the CIO and co-founder of BRETON Hill Capital. I've heard multiple times through the day that there aren't many macro funds in Canada, and yet I see lots of them on the panels. I'm another one. So I manage a macro fund. We've been put in business by the largest U.S. public pension plan. And our job is to find trends. We look for trends in currencies, in commodities, in equities, and then it's our job to be good risk managers, good traders, good security selectors in order to generate returns out of those trends. That's our job.
I'm Gary Ostoich, and as Nicolas mentioned, I have two hats. So my one hat is I chair AIMA Canada. AIMA, just very quickly, as an organization globally, based in the UK, started in 1990, over 1,300 corporate members in over 40 countries. AIMA Canada was established in 2003, actually by myself and two others. And currently we have over 85 corporate members that are made up of hedge funds, fund of funds, administrators, prime brokers, and actually institutional investors. And basically the job of AIMA is one of getting involved in policy development, education, interacting with the regulators, and also developing sound practices for the industry. So that's my volunteer position. My other positions with SPARTAN. So I've been in the hedge fund industry for 20 years, actually as a participant and also as an investor. Started out in the legal side for 15 years, left in 2004, and went and crossed the line, went to the hedge fund side. And SPARTAN, which I joined in 2009, had been around in 2006. And despite being up 3% in 08, basically, they lost all their assets. Went from 60 million to $3 million because fund of funds needed liquidity and they took it. So I came aboard. I had some experience building a business to rebuild their business. So we rebuilt it. So 3 went to 30, 10 investors went to 600. But the other part of the business that we do is actually we come across talent in the Canadian marketplace that are looking to launch a product. And you know, as we all know, it's hard to raise assets. We're not an incubator. I'd call us a breeding ground, in which we come across, they could be right across the spectrum of former hedge fund managers, prop traders, people who come off the institutional desk and want to start a fund. They become employees of ours. They be subject to our governance, our risk, our compliance, and we let them do what they do best, which is trading. So that's the other part of our business. Our AUM, quite modest. We're just almost at 80 million. We're trying to look for double of that every 12 months.
Great. So maybe what I'll do, I know nobody pays the high price of admission to listen to the moderator speak, but I'm going to just take a few minutes to just kind of set the table, a bit of a state of the union on the hedge fund industry, and just go through some factual rather than details about the industry, where we are today, the growth, and then I'll let the panelists kind of give their opinion on that, and we'll go through a few questions. I'm going to just echo some of the comments that were made by the previous moderator. I think there's hedge funds have very much gone from a nice-to-have kind of allocation to a much more more requirement in a portfolio for diversification purposes. I think the nice balanced fund perspective that we had, stocks and bonds, creating nice diversification over time. It's a story that held historically. I think with yields where they are today, that diversification's gone. There's no upside in bonds. So where do you diversify the equity risk that you need, that premium that you require in your portfolio? Where are you going to get that diversification from? Diversifying within the equity class, not easy, with correlations being extremely high. So I think that the place of alternatives in the portfolio is becoming much more a requirement than just a nice thing to have, which maybe has been historically. The industry is as big as it was pre-crisis now, in terms of AUM and in terms of number of funds. We have over 10,000 hedge funds, over 2.2 billion trillion of AUM. There's a bit of double accounting there because of the fund of funds. So you remove the kind of 450 billion in fund of funds. You still have almost $1.8 trillion in hedge funds, which is about where we were in 2008, maybe even a little bit above, with over 10,000 funds. What isn't growing is the fund-of-fund industry. So although the hedge fund industry has come back strong over the last few years, the fund-of-fund industry is consolidating and has actually not increased in size since 2008. So there is a kind of divergence there. The other thing we observe is the big are getting bigger. A lot of the fund flow, and we heard it on the CTA panel before, a lot of the fund flow is going to the large funds. And the big keep getting bigger, and it's not easy for the small people to obtain seeding and funding. Although we do have one wonderful exception on this panel, and Ray will talk us through that later. The growth is driven very much by institutions. So we have 2/3 of the funds coming into hedge funds coming from institutions, compared to around 20% maybe in 2003. So that's obviously a very significant factor. And we have a huge tendency towards managed accounts. So this is something, again, that we heard earlier on the previous panels. I was surprised when I saw the number at 42% of hedge fund investors now use managed accounts, which seemed like a huge number. But again, it seems to be that's a number of investors and not necessarily the assets under management. So again, to be taken with a little grain of salt. The inflows are very much going to long short, actually to long short, macro and CTAs. CTAs have been the big winners over the last couple of years. The Wintons of this world are getting that much richer and that much bigger. If we look at the CTA space, 4% of the CTAs have 76% of the assets. Right? So there's a very large discrepancy. It's a very asymmetric distribution in terms of AUM. A lot of small CTAs and a few very large ones. In the overall hedge fund space, it's similar statistics, a little bit less exaggerated. 4% of the universe owns around 60% of the assets if we look at the wider hedge funds. So still, the large ones are running most of the capital. Recent performance, just a couple of quick words and I'll pass it on. Since 2008, obviously 2008 was a big turning point for a lot of people. A lot of lessons were learned. 2009, 2010 were good years. 2011, not so great for the hedge fund industry as a whole. Probably 7 out of 11 hedge funds were negative. It's not to say there wasn't some great performances, but overall it wasn't a great year for the hedge fund industry, if we're looking at absolute returns as a criteria. This partly could be due to 2008, because as volatility spiked halfway through the year, people didn't get back in for the rally. Maybe memories of 2008 were still all that very recent, very fresh. But top performers last year were equity, stat arb, fixed income funds. Flows went into CTAs. So it's not necessarily the money wasn't chasing returns last year. It's still chasing strategies, which is not a bad thing. I think we should be investing in in hedge funds because of the type of payoffs and the types of returns they generate, not necessarily because of the very recent returns. So I think that's a good characteristic. And I think the industry is healthy. The Volcker rule is only going to push the industry to get larger with a lot of good talent leaving banks for hedge funds. So I think on the whole right now it's given the state of the investment universe and the healthiness of the hedge fund space, I think it's a good time to be in that environment. So I don't know if there's a...
Perhaps Gary. Gary should start. Gary, you can... Okay, what I can add is that, I agree with these numbers, of course, and from Professor Papageorgiou. And I can, what we witnessed when I was at INOCAP, it was really a shift in the global hedge fund industry towards more liquidity, more transparency. This is not something new. But perhaps what we saw is really now more and more, and two panels before they underlined this, the liquidity risk premium. Until very recently, the true alpha, true talent, I would say, was a bit mixed up with, the liquidity risk premium for most, I would say, or not most, some of these hedge fund strategies. And I think that now the global hedge fund industry really know what they do. They better know what kind of strategy when they go in, they take liquidity risk and are being paid for that. And they know where they have to look for true alpha and more, I would say, pure talent. And then, there are some challenges, but the industry, global industry, is evolving into that direction, I would say.
Yeah, I mean, I think another thing that's behind those numbers that I think is really important is that I think we're seeing a big structural shift in the marketplace of hedge fund investors. In 2001, post the tech crash, we saw a big change as far as institutionalization of hedge funds. I think we're seeing a shift that's just as important now, which is this. Lots of consolidation in the fund-to-funds world. That's something that is going to continue, I think, with even more momentum. That's really changing and concentrating allocations. And then the other big shift that's happening in parallel with that is the rise of sovereign wealth funds and large pension funds who are now direct investors, much more aggressive, much more deal-making mentality. And with the rise of those two groups, we see the rise of the people that advise them. And so now there are about probably 4 consulting shops that have become kingmakers in this industry. And if you hit their buy lists, then the inflows are massive. And that's part of what's behind the concentration of inflows that I think you saw, Nicolas.
And I guess one thing is, it can get depressing for a smaller manager listening to it, and smaller being whether that's sub 500 or sub $1 billion or whatever, is that, but I still think there's opportunities out there. I was actually at a meeting with a very large pension that they were talking about the fact that, study after study will show in terms of there tends to be more alpha with the smaller managers, and this pension fund does acknowledge that a lot of pension funds tend to go to their consultant list to do it, but this pension fund looks outside of it. And there's another one that I spoke to that it's a top 10 in the world that does the same thing. They're looking at the sub 500s. And yeah, they often access it by managed accounts. Mm-hmm. So, and I totally agree that that's where the flows are going, but there are investors out there that are looking for, I think performance has never been such a headliner as it is right now. Show me that what you're doing, whether it was last year or this year, and I think that's what's really up there, and people are willing to explore down to a sub 500 to say, what are you doing? Have you got something, a niche there? So, and I don't think the flows are going to change, and these are just small things, but it is out there, and you've seen it in the Canadian. And I know we'll touch on the Canadian marketplace, but the Canadian marketplace today. In fact, I was just speaking to somebody before coming in that told me an allocation they just got from a U.S. pension, and this isn't a $1 billion manager. And that is an interesting data point, and it's not the only data point. There's other data points out there of Canadian managers getting direct investment. It's true what you're saying. The fund of funds are disappearing, and these guys, a lot of them are going to direct. So anyway, I just think it's an interesting, there's still opportunity, I guess is what I'm trying to say.
Yeah. Do you mind if I jump in, Nicolas?
Yeah, please.
Yeah, I mean, I think you're right, Gary, because I think it's really not about assets, it's about talent. And so far, as I think about the panels we've had earlier today, we've had people point out the strength of the Canadian banking industry. We've had people point out that Canada is really a center of excellence when it comes to pension fund management. And I think that investment talent in Canada can compete globally as well. And I think you're right, Gary. And our firm is backed by a U.S. pension fund. And so I think we're another example.
Yeah, and I think the Canadian industry was tainted. And I'm not saying it's wrong that it was, but I think 5 years ago, and at AIMA, we keep a lot of data, we have been, about AUM size, number of members, blah, blah, size of hedge funds. And, 5 years ago, top 10 AUM managers were definitely dominated by long-biased, levered long-biased managers. Totally changed today. Like, if you look at the top 10 AUM of hedge funds in Canada, I think there may be one there that's long-biased, levered long-biased. And, just some rough numbers is in, 2007, probably, there was probably about $15 billion in the industry, and I'm excluding fund of funds, I'm excluding consultants, advisory fees, just hedge funds, guys, are men and women who are advising assets here, and whether their fund is a feeder fund in Cayman, but the advisors here. So that was, 15 billion, today not less than 30. So actually, we've had a big pickup, but actually, as somebody pointed out to me at a meeting, once again, a large pension, they think there's room for growth here, and I think to